say now?
Explain what one view means.
Alright, so the one view, this is from one point of view, the national income. Right, so all we're saying here is that national income can be viewed as where this leakages are equal to approximum of this, which are our injections into the economy. So what are leakages? What are injections, you may ask? Leakages, as the name sounds, is when money is coming out of the economy. Basically, injections are putting money into the economy. How we can put money into the economy? Through methods of investments, right? Investing in the economy. Through government spending, right? As well as through exports. Now, money comes out of the economy in the form of imports, taxes, and savings. That's one view. Right, we also have the next view, which is called the production view.
Wait, question.
Go ahead.
If leakages are greater than injections, then what happens
Okay,
to income?
so in common sense, you could use your common sense to answer that, right? You could just say, okay, if more money is coming out of the economy, then that's going to be a recession, right? But if more money is being injected into the economy, that's going to be economic growth. So that would have been the main difference right there, if you use your common sense. Next question, please. Or can I move on?
What are the values of production?
The values? Alright, so that's another way that in which you can view the national income, right? So the value of production is where we would say, okay, aggregate expenditure, or rather, we would say sales revenue is equal to our aggregate expenditure. Now, to put this into context, all we're saying is that, okay, sales revenue, amount received by those who produce the goods, amount received by those who produce, and when we move on to aggregate expenditure, all we're saying is, okay, amount spent by the buyers, right? So what we are saying is that, okay, when it comes down to the value of production, wherever sales revenue equal to aggregate expenditure, that's the next way in which we can measure our national income. Now, there's also next view to say, okay, the value of production can be where cost of production, including profits, are equal to total income, right? Now, as you realize, both of these methods are value of production method. So in equilibrium, so these are methods, this is the next point of view that you can use to measure the economy, right? That's like a next point of view. So this is one point of view with the leakages and injections, then the value of production is the next point of view. Now, in equilibrium, under the value of production, right? So we're just looking at the value of production to find the equilibrium in this case. We would say aggregate expenditure is equal to aggregate expenditure, which is equal to total income, right? Total income, we're saying this is going to be amount earned by the households, businesses, and the government. Alright? Get that? So, yeah, that's the next way in which you can view the economy. Any more questions?
No, let's move on to the measuring of national income.
Okay, the way in which we can now measure the national income. Alright, so we can measure national income two ways. We can either use the expenditure way, the expenditure approach, and the formula that you want to use for the expenditure approach is consumption plus I plus G plus net exports, right? And when we say net exports, we're saying, okay, exports minus imports. So this is the formula that you want to use. So consumption, right, we have C in terms of, those purchasing goods and services. We also have any investments into the economy, any type of government spending economy, plus or minus any net exports, right? Which is, net exports can be calculated by this guy here, exports minus imports. Right. Let me turn you guys a bit more. There we go. All right. So we also have the income approach. Income approach, which is going to be the total earnings. Well, it's basically just like this here. There's the total earnings by the business and the government. All right.
Gross domestic product.
Okay. GDP. That's something we have all heard of before. Final value of all goods. Of all goods in a period. See? Now, our GDP is equal to aggregate expenditure, which is equal to total income. Right? We also will have something that we call GDI, which is the gross domestic income. Right? Earnings of individuals, businesses, and the government. Can you please verify this information?
Yep.
That's correct?
Yep.
Earning of business, household, and individuals?
The total earning received by household business.
Okay, yes, that's great. Amazing, amazing. All right, so yeah, so we have the GDP, which can be measured by the aggregate expenditure, which is equal to total income. Now, you also have, going further, you also hear the word and national, is it and national product, NPI? Can you verify that?
Oh, NDP. Is it?
It's NDP? National Domestic, yes, that's correct.
That's net domestic.
Net domestic product, which under this condition, right, we are saying what is the net domestic product? We are saying, okay, the formula for this would be GDP minus indirect sales tax. Can you guys see? Minus indirect sales taxes minus any depreciation, and that would give us the net domestic product. All right. So these are a few concepts, economic concepts that everyone should be aware of. So yeah, we can also find the ND, national domestic income, as well. That's the next factor that we can find, the NDI, right? The NDI, what's the formula for the NDI? I believe it's the total income as well. Can you verify the NDI for me, please? You can't find the NDI? You should find NDI just below NDP.
I see NNP.
It's NNP?
Net national product.
Net national product. And what's the information as it relates to that?
The formula are
The formula.
NDP plus or minus net.
There we go. That's what I wanted. So this rubbish. It's NN. What's the acronym?
NNP.
NNP. So net national product. That's what it stands for, guys. Net national product, which of course would be the GDP plus or minus the net NDP, my bad. NDP plus or minus the net foreign income. Alright, so net foreign income means foreigners who bring in, who bring it out. And then you can find the net amount. Alright, so with that said, we have covered the basic ways in how you can measure gross domestic product, gross domestic income, NDP, which is national domestic product, as well as NNP, net national product. So those are 4 things to remember and how to remember the gross domestic product. All right, guys? Yeah. What else do we need to know today? Continue.
Okay. Just a moment there.
Sure, no problem.
So, what is circular flow of income?
Okay, that's what you should have asked first. That would have made more sense instead of having to go through all these when you're gonna just be clueless. All right, let's turn our attention a bit more over here. So today we're gonna be doing the circular flow. That's what should have been the first thing. Flow. How do you spell flow? Okay, so it's FLOW, flow. All right, so let's look at the circular flow. And what we're trying to say here is that, okay, we have the businesses, right? And we also have the households, right? Now, this can be, done with common sense, right? This can be done with common sense. So, right, the households provides factor services to the business, right? So we all know that factor service are things like land, they provide land to the business, labor, business cannot operate without labor, enterprise, as well as capital, right? So these are the factor services that the household provides to the business, and in return, of course, the business provides goods and services that the households consumption. In addition to that, the business has to also pay for these factor services to the households using factor payments. And factor payments come in the form of wages, rent, come in the form of wages, what else? Interest, profit, etc. Right? So they pay factor payments to the households for the factor services that are provided from the households to the businesses. So it's like that, right? Now, when the households are paid, they then leak money out of the economy through something that we call savings. So this is the first form of leakage that we are introduced to, which is savings. The savings goes to an intermediate institution, maybe like a bank, etc. Right? And then from this intermediate institution, they then go to invest into businesses. All right? So there we go. Investment is the first type of injection that we are introduced to, and savings is the first type of leakage that we are introduced to. Now, in moving on, we have some other factors as well. We now know that the households, right? Let's look at the foreign sector. Right? So when it comes down to the foreign sector, we are saying that we have both imports, right? And just for the circular flow of income purposes, okay, let's go over some more, guys. Right. So just for the circular flow of income purposes, we're saying that, don't look at imports as money coming into the country. You don't want to look at it that way. So what you want to do now, guys, to look at imports is that, okay, say for example, Jamaica sends goods to Canada, right? Who receives the money? Do you think it's Canada? No, because Canada is gonna have to pay Jamaica for those goods. And where is the money going, right? We're not looking at the fact that the goods are coming into the country when we are dealing with the circular flow of income. We are looking at the fact that where is the money going? All right. So on the imports, the money is gonna go out of Canada because they're gonna have to pay Jamaica for that goods. So which means money is gonna be leaking out of the economy, hence that would be a leakage. And on this side, exports, money is going to be coming into the economy because we are sending our goods from Canada to Jamaica, and then money now Jamaica is going to pay us for those goods, and money coming in to our economy, hence it's going to be a injection. All right, so we know now 2 injections and 2 leakages. Now, this is where the government comes in, right in the middle of the nitty gritty. Now, the government, of course, is going to tax the business. And then when they tax these business, that's the next form of leakage, right? However, the government also, they also do things for these businesses. They might provide transfer payments, TP. So they might provide transfer payments to households, for example. They pay for goods and services without, returning of anything or expecting anything. So that's a form of transfer payments, and transfer payments, the government is basically putting back things into its economy, because when they make a transfer payment, they're not expecting anything, and as such, it is then an injection. Also to the business, they make things like subsidiaries to the business, and that would be a next form of injection. So that would be the government spending on goods and services. So now we know the three injections, right? And if my student had asked earlier, then we wouldn't have to be confused when I wrote those S and T's and IM and all those letters to try to figure out what was going on. But yeah, so that is a next part. This was the first part in the economics to understand. But anyhow, can you move on to the next sector of the book?
You're done.
I'm finished?
Yeah.
The entire chapter?
Yeah.
You're too lie.
Good.
You're too lie.
Good.
I so much chat already? No, man, there's...
You did equilibrium and levels of national income.
Yeah.
You also did measuring national income.
I'm chat what you been, guys?
And then, yeah, that's it. And then you had test understanding.
Okay. No, man, go by next one. See me one there?
Oh, problem in measuring.
Okay, so yes, guys. So you miss something, man. No, you miss something, guys. I know I'm going to study more than this. All right. So the problems in measuring GDP. All right. So there are a few problems. One is that we can't account for intermediate goods. Meaning that, for example, we can't account for goods that, we have already counted. For example, if we do this, then we're going to double count the goods. Now, what we're saying is that we record goods at its value added amount, or final amount, slash final, can you guys see? Okay, great. So we record goods at its value added amount, slash final amount. And next thing that we also do, guys, is that we ignore stocks and bond. So even though this is a form of investment in the business world, we don't account for this in the economy, right? If we do, then the GDP is off. We don't account for stocks and bonds. The next thing that we do not do in economy is that we don't sell second-hand goods, or rather, we don't account for second-hand goods. So it's like Jim buy a good, then Mary buy a good day. Yeah, man, once Mary get it, we don't account for it. We have to account for the brand new goods, the final production of the good, right? So we say, okay, we don't account for second-hand goods. Other things that we don't record illegal activities or underground activities. We don't record it in the GDP. Activities, right? We don't record things such as donations, charities, gifts, EI. We don't do things like that, so that's out of the economy. Can you continue?
Yeah.
Can you verify this information before you continue?
Yeah, you're right. No.
Okay, it's good? Alright. Alright, guys, let me put you guys some more. We're going on more over. Okay, go ahead. Okay, what's there now? What's there? Come on. We don't have much time. It's after 10. Come on, the people are waiting. Come on.
In Excel.
Excel the some more?
By accident.
Jesus Christ. Guys, one moment, let me fix this issue because... One moment, guys. One moment, guys. I'm fixing the PowerPoint. There we go. So I guess where we're at right now. Alright. So basically I did see what they did. We're gonna drop nominal GDP. But the pounds in GDP, yeah, so that would have been right. Okay, intermediate, alright, great. Alright guys, now I'm back. Come on.
Okay. Economic growth.
Alright. So we're gonna explain something that we know as economic growth. Right? Now, two things you want to know is that you have the nominal, something called a nominal GDP, as well as you have something known as real GDP. Right? Now, under the nominal, we are saying that we record GDP based on the current year's level, and this level is at the price level. All right, so that's the nominal GDP. We also have the real GDP, where we record GDP based on the base year price. Pretty simple. Now, to give you guys an example, all right, so we have carrots, and say we have some banana. Right? So we have carrots and banana. You guys probably can't see nothing from there, but just listen, because it's better to listen. Right? So we have 2019 and we also have 2020. Right? Now 2019 being the base year. Alright, in 2019, right? In 2019 we produce, let us say, 2 carrots, right? At a price, right? At a price of $10, right? However, in 2020, we produce, let's say, 3 carrots at an increased price of $12. Now, that's for carrots. In terms of banana, in 2019, we produce, let us say, 3 banana at a price of $10. And in 2020, we produce 4 banana at a price of, let's say, $5. Alright, so the price of banana decreased. Cool? Alright, no problem. So we have carrot and we have bananas. We have different prices different here. Now, how do we calculate the nominal GDP? Well, what you want to do, guys, is to say, okay, remember, the definition states, record GDP based on the current year's level, right? So record GDP based on the current year level. Alright, so for carrots, under the nominal GDP, under who? The nominal GDP, we are saying it, alright. In 2019, we produced 2 carrots at $10, which is in total going to be a cost of $20, alright? So $20. Cool. Also, plus, in 2020, we produced 3 carrots at a price of $12. 3 12 is what? 36? That's going to be a total of 36, alright? Which in this case, 20 plus 36, that is going to be a total of, let me see, that's about $56. So this is the nominal GDP for carrots, right? This is the overall nominal GDP for carrots between the years of 2019 and 2020. Now, as it relates to bananas, right? We'll say, all right, 3 times 10, that's $30. Plus 4, 5, that is $20. All right. Now, the overall nominal GDP for bananas would be $50. Because obviously 30 plus 20 is 50. And therefore, the nominal GDP would be equal to the carrot plus banana final figure, which in this case would be $106. All right? So there we have the nominal GDP. Now, as it pertains to the real GDP, we're going up here a bit. So the real GDP is based on the base year. So for example, we have carrots now. Now, instead of saying, okay, right, in 2019, we had $10 being the price. All right, real GDP, base year, 2019. Price in 2019, $10. Base year price, that's what we use. So 2 times 10, $20. However, look where the twist, focus right here, guys. The twist comes in where we say, okay, all right, real GDP, we use the base year price. However, we're gonna use the current year's quantity. So it's gonna be 2020. All right, we produce three carat, but under the real GDP, we won't use 2020 price. 2020 price we won't use under the real GDP. Instead, we are going to use the base price of 2019, which is 10. So it's going to be 3 times 10 plus 3 times 10, which is going to equal $30. And under the real GDP, the real GDP for carrots between the years of 2019 and 2020 is going to be $50. Right? What time is it? 10:30. That's off. All right. So under the nominal GDP, it was 56, but under the real GDP, it was $50. So you get the calculations. All right. For bananas now, we are going to see. All right. 3 times 10 same way, because that's the base year price. However, moving on to 2020, we produce 4, but we refer back to the base year price, which is going to be 4 times 10. Which in this case, 4 times 10 is 40. So we'll say, okay, 40 and 30, 70. And then the real GDP for 2019 to 2020 is equal to 70 plus 50. And based on my calculations, that would give us a total of 120. Right, so guys, hope you guys learned something. Let me show you guys the board, going from this angle. Right, so hope you guys learned something tonight. This was a 26th lesson. This was the entire unit 2 in the economics chapter, produced by the lecturer, Uri Miller. So hope you guys learned something.